Welcome. Today we're diving into the world of dividends, one of the most important concepts every investor should understand. Whether you're new to investing or looking to brush up on the basics, this video will guide you through what dividends are, why they matter, and how they can impact your investment journey. We'll start by defining dividends, explore how companies decide to pay them, and discuss the different types you might encounter. By the end, you'll have a solid grasp of dividends and how they fit into your financial strategy. Let's get started on this essential topic for investors. Dividends are payments made by a corporation to its shareholders, usually as a reward for investing in the company. Think of them as a way for companies to share a portion of their profits with you, the investor. These payments can be made in cash, additional shares of stock, or even other assets. Not all companies pay dividends, but those that do are often well established and financially stable. Understanding what dividends are is the first step in recognizing their role in building long-term wealth. You might wonder why companies choose to pay dividends instead of reinvesting all their profits back into the business. The answer lies in attracting and retaining investors. By offering dividends, companies signal financial health and stability, making their stock more appealing. For mature companies with steady earnings, paying dividends is a way to reward loyal shareholders. It's also a sign that the company doesn't need to reinvest every dollar to grow, which can be reassuring for investors seeking regular income. Dividends come in several forms. The most common is the cash dividend, where shareholders receive money directly. Some companies issue stock dividends, giving shareholders additional shares instead of cash. There are also special dividends, which are one-time payments often tied to extraordinary profits. Understanding the different types of dividends helps investors anticipate what to expect from their investments and plan accordingly. When a company decides to pay a dividend, it announces a record date and a payment date. The record date determines which shareholders are eligible to receive the dividend, while the payment date is when the money or shares are actually distributed. This process ensures that only those who own the stock at the right time benefit from the payout. It's important for investors to keep track of these dates to maximize their returns. Dividend yield is a key metric for investors. It's calculated by dividing the annual dividend per share by the stock's current price. This percentage shows how much income you can expect relative to your investment. A higher yield can be attractive, but it's important to look at the company's overall health, as an unusually high yield might signal risk. Understanding dividend yield helps you compare different investment opportunities. Ex-dividend date is crucial for investors who want to receive the next dividend payment. If you purchase a stock on or after this date, you won't be eligible for the upcoming dividend. Buying before the ex-dividend date ensures you're on the record as a shareholder and will receive the payout. This date often affects the stock's price, as it typically drops by the amount of the dividend after the ex-dividend date passes. Many companies offer dividend reinvestment plans, or DRIPs, allowing investors to automatically reinvest their dividends into more shares of the company. This can be a powerful way to compound your returns over time, as you're using your earnings to buy even more stock. DRIPs are especially popular among long-term investors who want to grow their holdings without having to make additional purchases manually. Dividends can be classified as qualified or ordinary, which affects how they're taxed. Qualified dividends are taxed at a lower capital gains rate, while ordinary dividends are taxed as regular income. The distinction depends on factors like how long you've held the stock and the type of company paying the dividend. Understanding this difference can help you plan your investments and minimize your tax bill. Taxes play a big role in how much you actually keep from your dividend income. Depending on your country and personal tax situation, you may owe taxes on dividends received. Some countries offer tax advantages for certain types of dividends, while others tax them as regular income. It's important to consult with a tax professional or do your own research to understand how dividends will impact your overall tax picture. Dividend growth investing focuses on companies that not only pay dividends but also increase them regularly. These companies often have strong financials and a track record of rewarding shareholders. By investing in dividend growers, you can potentially enjoy rising income over time, which helps offset inflation and increases your total returns. This strategy is popular among investors seeking both income and growth. Blue-chip stocks are large, well-established companies with a history of reliable performance. Many blue-chip companies pay regular dividends, making them attractive to conservative investors. These stocks are often leaders in their industries and provide stability during market volatility. Investing in blue-chip dividend stocks can be a solid foundation for building a resilient portfolio. Real estate investment trusts, or REITs, are companies that own or finance income-producing real estate. REITs are required by law to pay out most of their earnings as dividends, making them a popular choice for income-focused investors. These investments can offer higher yields than traditional stocks, but they also come with unique risks related to the real estate market. Dividend aristocrats are companies in the S&P 500 that have increased their dividends for at least 25 consecutive years. These companies are known for their stability, reliability, and commitment to rewarding shareholders. Investing in dividend aristocrats can provide peace of mind, as these firms have demonstrated resilience through various market cycles. While high dividend yields can be tempting, they often come with increased risk. Sometimes, a high yield signals that a company's stock price has dropped due to financial trouble. It's important to look beyond the yield and examine the company's fundamentals before investing. Chasing high yields without proper research can lead to disappointing results or even losses. Dividend payout ratio measures the percentage of earnings a company pays out as dividends. A lower ratio suggests the company is retaining more earnings for growth, while a higher ratio means more is being returned to shareholders. Understanding this ratio helps investors gauge whether a dividend is sustainable over the long term. Companies sometimes reduce or eliminate their dividends when facing financial difficulties. This is known as a dividend cut and can lead to a drop in the stock's price. Investors should monitor a company's earnings, payout ratio, and industry trends to spot warning signs. Being aware of these risks helps protect your investment portfolio. There are several important dates associated with dividends: the declaration date, ex-dividend date, record date, and payment date. Each plays a role in determining who receives the dividend and when. Knowing these dates helps you plan your investments and avoid missing out on payouts. Finding quality dividend stocks involves research and analysis. Look for companies with a history of consistent payments, strong financials, and a reasonable payout ratio. Tools like stock screeners and financial news can help you identify potential investments. Remember, patience and due diligence are key to successful dividend investing. A well-constructed dividend portfolio includes a mix of companies from different industries and regions. Diversification helps reduce risk and ensures a steady stream of income, even if one sector faces challenges. Rebalancing your portfolio periodically keeps it aligned with your goals and risk tolerance. Investing in international dividend stocks can provide exposure to global markets and additional income opportunities. However, it also introduces currency risk and different tax rules. Researching the economic and political stability of other countries is essential before adding international stocks to your portfolio. Dividend-focused exchange-traded funds, ETFs, and mutual funds offer a convenient way to invest in a basket of dividend-paying stocks. These funds provide diversification and professional management, making them a good option for investors who prefer a hands-off approach. Always review the fund's holdings, fees, and performance before investing. Dividends can play a crucial role in retirement planning by providing a steady stream of income. Many retirees rely on dividend-paying stocks to supplement their pensions or Social Security. Choosing reliable companies and reinvesting dividends during your working years can help build a sizable nest egg for retirement. There are several myths about dividend investing, such as the belief that only older or slow-growing companies pay dividends. In reality, many innovative and growing firms also reward shareholders. Another myth is that dividends are always safe. While they can provide stability, no investment is risk-free. It's important to separate fact from fiction when building your strategy. When a company pays a dividend, its stock price typically drops by the amount of the dividend on the ex-dividend date. This adjustment reflects the payout leaving the company's assets. Understanding this price movement helps investors avoid surprises and plan their trades more effectively. There are several strategies for dividend investing, including focusing on high-yield stocks, dividend growth stocks, or a blend of both. Some investors prefer to reinvest dividends while others use them for income. Your strategy should align with your financial goals, risk tolerance, and investment timeline. Reinvesting dividends allows your investment to grow faster through the power of compounding. Each time you receive a dividend and use it to buy more shares, you increase your future dividend payments. Over time, this snowball effect can significantly boost your total returns, especially for long-term investors. The dividend trap occurs when a stock's yield looks attractive, but the company's fundamentals are weak. This can lead to dividend cuts and falling stock prices. Always analyze the company's financial health, payout ratio, and industry trends before investing in high-yield stocks to avoid these traps. Companies announce dividends through press releases and financial statements. These announcements include the amount, record date, and payment date. Staying informed about these updates helps investors make timely decisions and adjust their portfolios as needed. Company's dividend policy outlines how it decides when and how much to pay shareholders. Some companies aim for steady, predictable payments, while others adjust dividends based on profits. Understanding a company's policy can help you set expectations and choose investments that match your income needs. Special dividends are one-time payments made by companies, often after extraordinary profits or asset sales. These are not recurring and should not be relied upon for regular income. However, they can provide a nice bonus for shareholders when they occur. The dividend coverage ratio measures how easily a company can pay its dividends from earnings. A higher ratio indicates greater safety, while a low ratio could signal potential trouble. This metric is essential for assessing the sustainability of a company's dividend payments. During bear markets, dividend-paying stocks can provide a cushion against falling prices. While stock values may drop, dividends offer ongoing income that can help offset losses. Focusing on companies with strong balance sheets and a history of stable dividends is especially important in tough times. Young investors can benefit greatly from dividend investing by starting early and reinvesting dividends. Over time, the compounding effect can lead to significant wealth accumulation. Focusing on growth-oriented dividend stocks can also provide both income and capital appreciation. For those seeking regular income, dividend investing can be a reliable strategy. By selecting companies with a history of consistent payments, you can create a steady cash flow to support your lifestyle or supplement other income sources. It's important to balance yield with safety to avoid unnecessary risk. Dividends can help protect your purchasing power against inflation. Companies that regularly increase their dividends provide rising income which can offset the effects of inflation over time. This makes dividend growth investing an attractive option for long-term investors. Common mistakes in dividend investing include chasing high yields without proper research, ignoring company fundamentals, and failing to diversify. Avoiding these pitfalls can help you build a more resilient and successful portfolio. Always focus on quality and sustainability when selecting dividend stocks. When evaluating dividend stocks, consider factors like payout ratio, dividend growth history, earnings stability, and industry trends. These metrics provide insight into the company's ability to maintain and grow its dividend payments. Careful analysis helps you make informed investment decisions. Dividend-paying stocks can perform differently during various market cycles. In bull markets, they may lag behind high-growth stocks, but in bear markets, their steady income can provide stability. Understanding how dividends fit into different market environments helps you build a balanced portfolio. Interest rates can influence the attractiveness of dividend stocks. When rates rise, some investors may shift to bonds or savings accounts, causing dividend stock prices to fall. However, companies that consistently grow their dividends can remain appealing even in higher rate environments. Tax treatment of dividends varies by country and account type. Some accounts, like retirement accounts, may offer tax advantages for dividend income. Understanding the tax implications helps you maximize your after-tax returns and choose the best accounts for your investments. Economic conditions can impact dividend payments. During recessions, some companies may reduce or suspend dividends to conserve cash. Focusing on firms with strong balance sheets and a history of weathering economic storms can help protect your income during tough times. Managing risk is essential in dividend investing. Diversifying across sectors, monitoring company health, and avoiding overconcentration in high-yield stocks can help reduce potential losses. A disciplined approach ensures your portfolio remains resilient in changing market conditions. Regularly reviewing your dividend portfolio helps ensure it stays aligned with your goals. Check for changes in company performance, dividend policies, and market conditions. Rebalancing and making adjustments as needed keeps your investments on track for long-term success. Dividends are a powerful tool for building wealth and generating income. By understanding how they work, the risks involved, and the strategies available, you can make informed decisions that support your financial goals. Remember, successful dividend investing requires research, patience, and a focus on quality. Thanks for joining us on this journey to mastering dividends.